What I'm about to share with you today is one of the biggest real-world signals we've seen in the precious metals space in years, maybe decades. China, the largest physical gold marketplace on the planet, appears to be running out of deliverable gold bars. Let me say that again. China, where more physical gold changes hands than anywhere else on Earth, looks like it has effectively gone dry just days after the Chinese New Year holiday. This is not speculation. This is not internet rumor. This is coming from major dealers on the ground in China who are now refunding customer contracts because they simply can't fulfill orders. At the same time, India has posted record gold imports for January. Record imports. The two largest physical gold-consuming nations on Earth are sending a message right now. And if you're watching the data instead of the noise, that message is crystal clear. The East is accumulating physical metal at a pace we have not seen before, while Western markets remain fixated on paper prices, futures positioning, and digital volatility. Before we go any further, I want to hear from you. Drop a comment right now and tell me where you're watching from. Are you in the United States, Canada, the United Kingdom, Australia, India? I want to know where our community is located. Drop your country or your city in the comments. It helps us understand who we're reaching, and it helps build a community of people who want real information, not scripted mainstream talking points. So comment below. Where are you watching from today? Now, let's get into what's actually happening because the details matter. One of the clearest pieces of evidence comes from Hoodigan. For those who don't know, Hoodigan is a major precious metals dealer in China. They operate under Doing Jewelry Group, one of the largest and most established gold jewelry conglomerates in the country. We're talking more than 3 decades of history, hundreds of partner stores across China, and a serious footprint in gold recycling and buyback services. This is not a fringe shop. This is a core part of China's physical gold ecosystem. And here's what Hoodigan just told customers in a public notice. I'm going to read it directly so you understand the exact wording. Quote, "Due to the unavailability of gold after the Spring Festival, our products are out of stock and we are unable to ship your order. You can apply for a refund and we will process the refund for you." End quote. On the surface, that sounds like standard corporate language. Out of stock. Apply for a refund. Nothing dramatic. But think about what that statement actually reveals. This is a major gold dealer telling customers that gold is unavailable. Not that pricing changed. Not that there's a delay. Unavailable. They can't ship because they don't have the metal to ship, and they're not alone. Reports are emerging that multiple gold retailers across China have abruptly stopped selling physical gold bars. Contracts signed before the holiday are being refunded because the inventory to fulfill those contracts simply isn't there. Physical inventory across retail and wholesale channels in China appears to have evaporated. Some traders on the ground are warning this could be an early signal of a historic repricing event where numbers like $10,000 per ounce gold are no longer treated as hype, but as a serious scenario being discussed by people who actually handle physical metal and actually see what's available, what's scarce, and what's disappearing. Now let's talk about timing because the timing matters. Chinese New Year is the most important holiday period in China. It's a season of massive gold buying. Families purchase gold. Gifts are given in gold. Jewelry sales surge. This is peak demand season in the world's largest physical gold market. So what happened? Demand was so intense and supply was so constrained that major dealers ran out. They couldn't restock. They couldn't fulfill. They had to refund. That is not a normal inventory fluctuation. That's a structural signal. When the largest physical gold market on Earth cannot source deliverable bars during peak season, something fundamental has shifted. The question you should be asking yourself right now is whether this is a temporary disruption or the beginning of a larger dislocation between paper prices and physical availability. Now, while this is unfolding in China, let's look at what's happening in India. Macro analyst Tavi Costa recently shared data showing that India posted record gold imports in January, unprecedented tonnage. India has always been a major gold-consuming nation. Gold is deeply embedded in Indian culture, savings behavior, weddings, and family wealth preservation. But what we're seeing now looks bigger than cultural demand. Indian importers appear to be positioning early. They appear to be preparing for a systemic pivot, global rotation away from paper exposure and toward tangible reserves, a rotation away from derivatives and into physical metal, a rotation away from financial engineering and toward real assets. Think about what that means. China can't source enough gold to satisfy domestic demand. India is importing record amounts of gold. The two nations that consume more physical gold than anyone else on the planet are aggressively accumulating metal right now. Meanwhile, a large portion of Western investors remain distracted, focused on screens, spot quotes, ETF flows, and paper volatility, often unaware that the real action is happening in physical metal, not in futures contracts, not in synthetic shares, but in bars and coins changing hands in Shanghai and Mumbai. The charts don't lie. That's what Tavi Costa said, and he's right. When you look at import figures, dealer inventory reports, and premiums in Asian markets, the message is unmistakable. The East is consolidating a different kind of power, not power measured in leverage, algorithms, or notional exposure, power measured in atoms, power measured in physical metal held in vaults, safes, and hands. Now, a quick note for people watching this channel for the first time. If you're new here, welcome to Bridgeport Finance. What we do here is cut through the noise. We don't sell hype. We don't sell fear. We don't tell you gold is going vertical tomorrow, and we don't tell you the world ends next week. We look at the data, we examine both sides of the equation, and we give you the clearest possible picture of what's actually happening in these markets. I'm not here to tell you what to do with your money. That's your decision, your portfolio, your risk tolerance, your time horizon. My job is to make sure you have access to information you're unlikely to get from mainstream financial media, especially around physical markets, on-the-ground developments in Asia, and the growing disconnect between paper pricing and physical reality. If this kind of analysis helps you, if it brings clarity, if it helps you make better informed decisions, make sure you're subscribed to our channel, Bridgeport Finance. Now let's talk about what this means for silver, because this is where it gets really interesting. There's an old saying in precious metals, where gold goes, silver follows. Gold and silver are two halves of the same monetary story. They've been used as money and wealth storage for thousands of years across virtually every civilization. Gold is the senior metal, the king, if you will. But silver is the little sister. And historically, silver has a habit of outperforming gold during powerful precious metals bull markets. Silver catches up. Silver closes the ratio. Silver makes its move after gold clears the runway. So if gold is running out in China, if India is importing record tonnage, if physical inventory is tightening in the largest markets on Earth, what do you think is coming for silver? Here's what the data suggests. Global silver supply is under extreme pressure. That might sound dramatic, but walk through the fundamentals. Silver has faced structural deficits for years. Demand has outpaced new mining supply. Industrial demand keeps growing, driven by solar panels, electronics, EVs, grid infrastructure, medical applications, and high-end manufacturing. At the same time, investment demand rises when people start questioning the stability of fiat systems and the credibility of paper claims. And here's the key. The silver market is tiny compared to gold. Much smaller, much tighter. When demand surges in silver, there's far less slack in the system. There's nowhere to hide. Price has to do the work. And right now, we're seeing patterns in silver that rhyme with what we're seeing in gold. Dealers struggling to source physical metal. Premiums expanding. Inventory thinning. The retail market showing unusual strength. Remember what we discussed in the previous video. Bullion Star reported it was difficult, near impossible, to source physical silver. Golden State Mint paused silver sales because they couldn't secure supply. The UK's largest precious metals refiner and retailer, Beard & Company, shut down online sales. These are not isolated incidents. These are symptoms of a market where physical demand is pressing against limited supply. And here's the central point. While physical demand is intense, while dealers can't source metal, while premiums expand, paper prices can still swing, stall, or even decline. This is the disconnect. This is the divergence between paper reality and physical reality. Paper reality says, look at the futures, quote, the spot price, the COMEX print. Physical reality says, try to buy metal. try to get it delivered, see what premium you pay, see what the wait time is, see if inventory even exists. Those two realities are telling very different stories right now. Let me give you specific examples. Shanghai spot silver has traded at meaningful premiums relative to Western pricing. We've seen reports of large premiums on China's major e-commerce platforms, sometimes extreme. Physical silver products have been listed at massive markups versus US paper quotes. Let that sink in. Chinese buyers have been willing to pay far above the Western paper price to secure physical metal. Either they're irrational or they understand something the paper market isn't reflecting. I know which interpretation I find more convincing. When the gap between fundamental value and paper price stretches to extremes, it becomes a pressure system. And in market history, pressure systems don't stay stable forever. Eventually, the physical market forces the paper market to reconcile. Now, in Bridgeport Finance Chanel, we're going to cover both sides. We're not going to ignore risks. We're not going to pretend markets move in a straight line. So here's the bearish case, and then I'll give you the bullish case. The bearish case looks like this. We're in a period of significant volatility. Risk assets are under pressure. Liquidity can tighten quickly. And when liquidity tightens, when traders face margin calls, when portfolios must be rebalanced, everything can get sold. Gold and silver are not immune to liquidation events. We saw it in 2008. We saw it during the initial COVID crash in March 2020. Metals sold off with everything else as traders scrambled for cash. We've also seen margin requirements rise in paper markets. Higher margins increase the cost of holding leverage positions. Overextended traders get forced out. That can create cascading sell pressure in futures markets regardless of what's happening in physical markets. If your margin requirements jump and you're leveraged, you may be forced to sell even if you believe the long-term thesis. The market can stay irrational longer than you can stay solvent. There are macro headwinds too. A stronger dollar can weigh on metals in the short term. Shifts in interest rate expectations can pressure sentiment. Geopolitical shocks can trigger an initial liquidation wave before safe haven buying takes over. We've seen that pattern repeatedly. First comes forced selling, then comes the flight to safety. So the bearish case is simple. More short-term pain is possible. Paper prices could fall further, even as physical premiums remain elevated. The disconnect could persist longer than most people expect. Anyone over-leveraged or anyone without a plan can get hurt badly in this environment. That's the bearish case. Now, here's the bullish case. It starts with what we just covered. China is running out of deliverable gold in key channels. Major dealers cannot fulfill orders. India is importing record amounts. The two largest physical markets on Earth are in accumulation mode. This isn't abstract. This is observable. This is documented. You can verify dealer notices and import data. And when the largest physical markets tighten, when dealers can't source metal, when premiums expand aggressively, that is the market signaling that paper pricing is not reflecting real supply and demand. And eventually, markets reconcile. Gold has been in a powerful long-term uptrend. Silver has shown strength across multiple cycles. Fundamentals matter, supply constraints, rising industrial demand, rising investor demand, and growing skepticism toward debt-heavy fiat systems. And zoom out even further. Central banks have been accumulating gold at elevated levels relative to history. This isn't just India and China. Globally, official sector demand has been meaningful. Why? Because central banks understand the logic of reserves. They understand counterparty risk. They understand that paper promises depend on the system functioning smoothly, and systems don't always function smoothly. Analysts call this the Great Rotation. A rotation from fiat debt to physical wealth, from paper claims to tangible reserves, from synthetic exposure to elemental certainty. This isn't fringe anymore. This is a strategic trend playing out in real time. The question is whether Western investors wake up early or later after the easy supply is gone and the repricing is already underway. Let me tell you what I'm watching in the coming weeks, because signals matter. First, I'm watching Asian markets closely: Shanghai, Hong Kong, Tokyo, Singapore. Asia opens first and often sets the tone. If premiums remain elevated or expand, that's a bullish physical signal. If tightness spreads, it becomes harder to dismiss. Second, I'm watching dealer inventory and premium data. Are more dealers reporting sourcing issues? Are delivery timelines stretching? Are premiums rising or falling? That's the real-time pulse of the physical market. Third, I'm watching the COMEX and LBMA inventory categories registered versus eligible reported vault levels and the direction of change. These numbers fluctuate, but trend matters. If available metal continues to tighten, it adds stress to paper structures. Fourth, I'm watching central bank purchasing trends and any signs of acceleration or slowdown. Official sector demand has been a major pillar of gold's strength, and shifts there matter. Fifth, I'm watching geopolitics Middle East, Eastern Europe, the Taiwan Strait. Any serious escalation can alter flows fast. Safe haven demand during genuine crisis events can overwhelm everything else. But remember, the first move can be liquidation before protection buying arrives. Quick pause. How are we doing? If you're still watching at this point, you're not here for sound bites, you're here for depth. You want analysis, not entertainment. That's exactly who this channel is for. If you're getting value from this, share it with someone who needs it. Send this video to a friend who's trying to understand what's happening in gold, silver, and real-world supply. That's how we grow a community of informed investors who can cut through the mainstream noise together. Now let's zoom out to the bigger picture, because this isn't only about gold prices or silver prices. This is about a shift in the global financial architecture, a shift that has been building for years and now appears to be accelerating. For decades, the global system has leaned on credit expansion, fiat currencies backed primarily by government credibility, debt compounding, and layers of derivatives built on top of underlying assets. Paper claims multiplying faster than real assets. Leverage stacked on leverage. That structure can run for a long time until stress reveals the weak points. What we're witnessing now looks like an early-stage return to tangible reality. When China's dealers struggle to deliver metal, when India imports record tonnage, when premiums surge in Asia, that's the real economy pushing back against the paper economy. This won't be smooth. It won't be linear. There will be volatility. There will be interventions, margin changes, and periods where paper prices and physical availability don't match. But directionally, the signal is clear. Physical is gaining ground. Atoms are beating algorithms. Real constraints are challenging synthetic abundance. And the nations and individuals who recognize this early, who position with appropriate risk management and a clear time horizon, will likely be better prepared than those who remain dependent on paper claims alone. This is why I keep emphasizing the difference between physical metal and paper exposure. Owning shares in a gold ETF is not the same as owning gold. Holding a futures contract is not the same as holding allocated metal with direct legal title. When confidence breaks or delivery becomes stressed, you want clarity on what you actually own and what you're relying on someone else to deliver. Now, for those of you who are newer to precious metals or trying to translate information into action, here are the practical foundations. First, know your time horizon. Are you trading short-term moves or investing for multi-year wealth preservation? Those are completely different strategies with completely different risk profiles. Second, know your risk tolerance. How much volatility can you handle without panic selling? Don't overextend. Don't deploy money you can't afford to lock up. Be careful with leverage, especially in environments where margin rules can change quickly. Third, prioritize physical if your goal is protection against systemic risk. Coins, bars, rounds held directly or stored in properly allocated structures where you have clear title. Paper products can be tools for trading, but they do not provide the same form of insurance as physical ownership. Fourth, have a plan. Know what would make you add. Know what would make you reduce. Don't make emotional decisions based on daily price moves. Build a thesis and follow it. Fifth, do your own due diligence. Nothing I share should be taken as financial advice. I'm giving analysis and interpretation of data, but your goals, constraints, and risk profile are unique. Use this as one input among many and make your own informed decisions. Now let me bring it back to where we started. China's gold supply situation is tightening. India is setting import records. Silver supply dynamics remain structurally stressed. The physical market is sending signals that are hard to ignore. The paper market is often telling a different story. One of these realities eventually overwhelms the other, and I know which side I find more compelling. The side backed by physical metal changing hands, the side backed by dealers refunding contracts because inventory isn't available, the side backed by record imports and elevated premiums. The paper market can create an unlimited number of contracts. The physical market cannot create unlimited gold or silver. Eventually, that constraint matters. Eventually, reality asserts itself. Timing is uncertain. It could take weeks. It could take months. Markets can stay disconnected longer than seems rational, but the directional pressure is clear. Physical demand is persistent, and the great rotation appears to be underway. So let me leave you with 3 key points as we wrap up. China's gold supply situation is highly unusual. Major dealers out of stock, refunds issued, inventory vanishing after peak season. This is the world's largest physical gold market signaling stress. Watch it closely. India's record imports, combined with China's tightness, strongly suggest Eastern accumulation is accelerating. 2 nations representing a massive share of global physical demand are acquiring metal aggressively. That's strategic behavior, not emotional trading. Silver follows gold. What's happening in gold may be a preview for silver, but silver's market is smaller, tighter, and historically more explosive when it moves. Industrial demand keeps rising, investment interest increases in uncertainty, and supply constraints don't resolve overnight. When silver moves, it can move fast. That's where we stand. The physical market is flashing signals that something historic may be building. The paper market is working hard to keep things looking normal. Those 2 realities can't coexist forever. Stay informed. Stay positioned appropriately. Stay connected with this community so you get real-time analysis as this develops. Do your own due diligence, understand the risks, have a plan, and know your time frame. If you're over-leveraged, you can get hurt badly regardless of long-term fundamentals. If you're positioned responsibly with a long-term horizon and physical exposure where appropriate, these are exactly the kinds of conditions you prepare for. Is the great rotation accelerating? Is physical about to overwhelm paper? I want to hear your thoughts in the comment section.